Hello everyone. So in today's video, I'll be discussing about safe harbors within the transfer pricing domain. So what do we understand by safe harbor? So essentially, safe harbor is a provision that applies to a defined category of taxpayers and controlled transactions, which provides relief to eligible taxpayers from certain obligations which are otherwise imposed by a country's general transfer pricing rules. So essentially, what it provides is it fixes simpler percentages, or it fixes the price or the price of the interest that should be charged on a particular loan transaction. And as a result, if you comply with those rules, you will be exempt from certain compliance obligations. So essentially, it is very appropriate for some certain smaller taxpayers or less complex international transactions. So let me give you a very simple example. If safe harbor rules say that for a provision of software services, cost plus minimum 20% is considered as a safe harbor. Then suppose Infosys, which is providing software services to its associated enterprise in Ireland, charges a cost plus 22% for the services. Since 22% is above the minimum markup of 20%, this transaction will be considered to be at an arm's length, and Infosys can opt to apply safe harbor provisions. Once an assessee or a taxpayer opts for safe harbor provisions, no separate benchmarking of transactions is required to be done. So to summarize, what is safe harbor? It is essentially a set of rules compliance with which will ensure certainty. It is a set of preset margins or interest rates for loans, etc. And once you opt for safe harbor provisions, then you will not be required to maintain a separate transfer pricing documentation to substantiate that your international transaction is meeting the arm's length conditions. Now, coming to a little bit of the law and the background of safe harbor provisions. So, the OECD transfer pricing guidelines also contain safe harbor provisions. So, para 4.102 of the OECD transfer pricing guidelines 2017 talks about safe harbor. It defines what safe harbor means. It says that a safe harbor substitutes simpler obligations for those under the general transfer pricing regime. Then in the Indian Income Tax Act, Section 92 CB of the Income Tax Act defines what is a safe harbor. It says circumstances in which the tax authority shall accept the transfer price declared by the eligible taxpayer. Now, a bit of a background. The Indian Safe Harbor rules were created pursuant to the Rangachari Committee's report for creation of a non-adversarial tax environment. The government introduced the Safe Harbor rules in September 2013. Under the Safe Harbor rules, the tax authorities accept the transfer price, which is declared by the assessee as the arm's length price. The rates under Safe Harbor mechanism are like presumptive taxation, which generally encourage taxpayers to opt for the same for not having to be involved in protracted litigation. There have been various notifications for revising the rates over the past few years. The latest Safe Harbor notification was released. A circular was issued by CBDT in December 2023. Now, coming to the rules of Safe Harbor in the Indian income tax rules. So, Rule 10TA to Rule 10TH apply to Safe Harbor provision. Any taxpayer who has entered into an eligible international transaction and wants to exercise the option to be governed by the Safe Harbor rules is required to file Form 3C EFA on or before the due date of furnishing return of income, declaring whether the transaction entered with an associated enterprise is an international transaction, what is the quantum of the international transaction, whether the associated enterprise's country or territory is a no tax or low tax country or territory, and the operating margin, operating profit margin, or the transfer price. If a classification as declared by the assessee has been accepted by the transfer pricing officer in 1 year, then it cannot be recharacterized if there is no change in the agreement in the subsequent years. Now, the next couple of slides, they give the safe harbor rules, the margins that have been prescribed within the safe harbor rules under the Indian income tax law. The eligible assessee under the safe harbor rules is defined in Rule 10TB. The definition is quite exhaustive. You need to refer to it before actually opting for the safe harbor provisions. This particular slide, it is giving different margins. So I will just pick up one or two examples. For example, for provision of corporate guarantee, it is saying that 1% will be considered as a safe harbor. So what it means is that if between two associated enterprises, one of them has given a corporate guarantee to another, has provided corporate guarantee for the other associated enterprise, he should be charging a markup of a margin of 1%, and then the transaction will be considered to be at an arm's length, or the person will be considered to be within the safe harbor provisions as provided under the Indian income tax law. Coming to intra-group loan safe harbor, so there are various rates which are provided as per the credit rating of the associated enterprise. There is also a mention for low value added intra-group services. Low value added intra-group services, it says, it first of all defines it as services which do not form part of the core business of the assessee. They should not be shareholder or duplicative activities. They shouldn't use intangibles nor result in creation of intangibles. It shouldn't be R&D activities, manufacturing and production services, IT, software, KPO, etc. Then the computation of management service fee transaction to be certified by an accountant. So what this particular provision is essentially saying that if you're providing low value added intra-group services up to 10 crore rupees of transaction, then the markup should not exceed 5% in such a case. So if you notice this slide, like it gives various categories for which safe harbor rules are provided. So say software development, ITES, KPO, contract R&D for software development, contract R&D for generic pharmaceutical drugs, provision of corporate guarantee, manufacture and export of core auto components, and manufacture and export of non-core auto components. Then there are certain thresholds which are provided, monetary thresholds, and if accordingly the markup is provided. Similarly, for loan transactions, we saw that the credit rating is provided and whether the loan is denominated in Indian currency or foreign currency, and accordingly the base rate plus percentage margin rate has been provided. And the low value added services we've already discussed. Now coming to the procedure for opting for the safe harbor rules, that is also given in the rules. The procedure essentially, it involves application which needs to be filed in the prescribed form 3C EFA on or before the due date for filing the return of income before the assessing officer. A particular timing is given, there are certain conditions. Then there is a procedure also mentioned for the subsequent years. There is a provision for the validity of the safe harbor rules. These rules also talk about the assessment or the audit procedure for the safe harbor rules when they are being opted. So they are different from the normal tax audit or the transfer pricing audit procedure or the rules. So essentially, just to summarize, safe harbor rules are very good. They give you a lot of certainty for taxpayers who are want to avoid protracted litigation. They want to avoid the costs of compliance. And if you are falling, you can always look at the safe harbor rules as a starting point. You should first see what are the margins which are provided within the safe harbor rules, and in case you are complying with them, then you should opt for the safe harbor rules. You should look at their provisions in depth. And if you have any questions or any queries, please do get in touch with me. I would be happy to support you. Thank you so much for watching the video. Do leave your comments and see you soon in the next video.